The best investors are dead. It might sound morbid, but buried within this grim notion lies a pivotal lesson for today's investors. So, in this video, I'm going to share how embracing the principles of dead investors could very well revolutionize our approach to investing while we're still here on Earth. But first, let's talk about the urban legend that drives this idea. There's an intriguing rumor circulating about a 2014 study supposedly conducted by Fidelity. Their aim was to pinpoint the best performing accounts from 2003 to 2013. Interestingly, the findings revealed that individuals who had either forgotten about their accounts or, quite unfortunately, had passed away, resulting in inactive accounts, actually had the best results. Yet, as much as I've searched, the study itself remains elusive. If anyone can get their hands on it, send it my way. I'd love to read it. Or do you think that it actually is an urban legend? My friend Joe is actually the one who turned me on to investing in the first place, telling me to open a brokerage account and start buying stocks. But shortly after sharing that advice with me, life got really busy for Joe. Between his work obligations and raising a young family, he took his hands off the wheel and his portfolio was essentially on autopilot. A few years went by, and you know what? His portfolio was doing great because from the get-go, he had done his research, invested in high-quality companies and index funds. So the first lesson of investing like the deceased is to forget you have an account. Not really, but you get the point. Turns out that when we're buying and selling like mad and jumping on to the next big meme stock, we're actually doing ourselves a disservice. Like my friend Joe, we can create automatic investments, turn on the drip, and then patiently wait for the magic to happen. That is passive investing. At its core, this strategy advocates for buying and holding onto investments for the long term, avoiding the practice of frequently buying and selling. It serves as an antidote to the flawed pursuit of market timing, which instead emphasizes the importance of education and investing with a long-term mindset. But if you're anything like me, you love investing and enjoy the process of reviewing your holdings and watching and waiting for those opportunities to arise. Why would you want to give up the fun that's investing? Well, I don't think we have to do that. I do think you need to strip the emotion because let's face it, a dead investor can't be emotional about market volatility, and maybe that's part of the secret. So have you ever heard the term behavioral finance? This is where us investors, we get all spun up in our fear and our greed. We make impulsive decisions. Sound like anyone you know? I think if you held a mirror in front of my face, you might see a younger version of me who just really didn't know any better, you guys. But I've learned, I've evolved, and I've changed my investing strategy, which is why I wanted to share it with you. I don't want you guys to make the same mistake that I did. So how do we play dead and implement a strategy that allows for a more passive approach to investing, where we still get to enjoy the process and add some individual holdings as well? Well, one strategy is to develop a core in your portfolio through index investing. It's pretty straightforward. Purchase a benchmark index like the S&P 500 index and hold on to it for the long term. This type of investing also allows for instant diversification, which reduces your risk. When you purchase an index fund or even an ETF, depending upon the one you select, you may be the proud owner of 100, 250, 500 different companies. It keeps it simple for you. And if an index fund is at the core of your portfolio, meaning it makes up the vast majority of your portfolios, or maybe even 50% of your portfolio, it then allows you the opportunity to still dabble in some of the individual holdings. This is called the core satellite strategy. Why is it fundamental? Well, attempting to time the market is like searching for the fountain of youth that doesn't exist. No one, regardless of their expertise or intuition or education, can accurately predict the future and what the markets are going to do. Passive investing works because overthinking and constantly buying and selling investments is what tends to lead to our downfall. On the other hand, deceased investors, with their frozen assets, avoid these pitfalls. The goal here is to mirror their disciplined approach without, well, being dead. So why does this strategy work? Well, to start, there's lower fees. Index funds have super low fees since they don't involve picking individual stocks. It's just following the index. The other thing I appreciate about index funds is the transparency. You always know which assets are in the index. You can easily pop over to Seeking Alpha, like where we are here, type in the ticker of an index fund. So let's pop in VOO, which is the Vanguard S&P 500 ETF. And you can see in the last year, it's up 20%. We can look at the holdings breakdown and see that the S&P 500 is largely leaning towards technology with almost 30% in technology. Healthcare makes up almost 13%, financials 12%. You guys can see the rest. Top 10 holdings? Real quick, Microsoft, Apple, Amazon, Nvidia, Alphabet Class C, Meta Platforms Class A, Alphabet Class C, Tesla, Berkshire Hathaway, United Health Group. Or you can just do a Google search, head on over to Vanguard. You can see that it's an index fund. The expense ratio is only 0.03%. And if you scroll through, there's a ton of information that you can peruse while you're wearing your soft pants and drinking your beverage of choice. And if you move towards the bottom of this website, which I'll link for you guys if you want to take a peek, you can see there's the top 10 holdings. And if you really want to, you can move through all of the different pages and see what all the holdings are. Now, I am not a tax professional, so kudos to all those tax professionals out there, but the buy and hold strategy also has the potential to minimize your taxable events. And if you purchase an index fund and house it in a Roth IRA, presto bammo, tax-free growth. Still not convinced? Consider this. Almost 80% of active mutual fund managers underperformed the S&P. These are professionals in the field, you guys. Their job is actually to manage the funds, yet the vast majority couldn't outperform the market. So why do we think we're going to fare any better? Just something to think about. Having shared my investing journey, full of mistakes stemming from emotionally driven decisions, I've now pivoted to that core satellite strategy, and each week continue to add to my core ETF holdings. I'm embracing that more passive, rational approach akin to the investing habits of the dearly departed. I'm even attempting to create some structure around it with Prosperity 52, where I'm buying something, could be a fraction of a share every week, in my commitment to living a more prosperous life in all the things. What about you guys? Are you all adopting a more passive approach to investing? Leave me a comment below and then go and take a peek at this video next.